My number one advice to the young people: do not invest in the present. The present is not what moves stock prices. Change moves them, and I want you to. I think history is going to win. That's once inflation gets about 5%. It's never come down without a recession, and I think a recession is in the cards. I just don't know when. We have about, depending on who you listen to, $1.5 to $2 trillion of excess savings now. So it may take some time to work through that savings, but given the extent of the asset bubble and the destruction in the markets, given what's going on in Ukraine, given zero COVID policy in China, I don't take a lot of comfort from that. So I assume, and I pretty strongly assume, we're going to have a recession sometime in 23. I just don't know whether it's going to be in the early part or the later part. And again, I mean, one of the most challenging things for me right now is, maybe it says something about my dysfunctional personality, but I've always made even higher returns in bear markets than bull markets. But the way I did it was just pretty much ignore equities, take them off the table, buy bonds, buy treasuries, and go home. Well, I've never been presented a cocktail where you have 8% inflation, you think the economy might weaken, and bond yields 3%. It's an analog with no precedent in history, because we've never had central banks with situation in Europe, for example. We have negative rates with 8% inflation, or even here, we've never had anything like this. So you can't get into black and white. That it's an art form, investing in. From cycle to cycle, you have to constantly innovate and not just be a slave to past models. You can't build over $2 trillion in wealth, in purchasing power, and then take $1 trillion of it out and not matter. John, I also have high frequency signals, and there certainly seems to be a strong correlation between crypto and the NASDAQ. I don't think it takes a genius to figure out why. So I'm looking at it as an indicator that way. Crypto, everything that Charlie Munger says about it, I'm sympathetic to. Everything that says Bill Miller says about it, I'm sympathetic to. So I think that's a movie that has yet to be played out, and one that I don't want to bet on in conviction, but I will be very surprised if blockchain isn't a real force in our economy, say 5 years from now to 10 years from now, and not a major disruptor with companies that will have been founded between now and then that'll do very well, but that will also challenge things like our financial companies and do a lot of disruption. So I find crypto interesting. My 69th birthday is in a couple of weeks. I'm probably too old to compete intellectually with the young people in this space, but I'm certainly monitoring it. I'm not sure why, other than NASDAQ type risk takers are the ones that tend to play in Bitcoin, and curmudgeons that are gold bugs and want the world to fall apart play in gold. But there's no question, and this I've watched, and it's gone on long enough now that I believe it, that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase for other assets, you want to own gold. And I think I just articulated the reason, but sometimes, John, I don't care. This has gone long on enough that I'm starting to believe what I'm observing. And for sure, if I think we're going to have an inflationary bull market, I'd want to own Bitcoin more than gold. And if I thought we're going to have a bear market, stagflation type thing, I'd want to own gold. Doesn't mean I'm going to believe that in a year, but that's my assumption going forward from this point. It's 85% what I've observed, but I would also say it's the type of investor. Over-the-counter FANG type investors, if they believe in inflation and they tend to be younger, they want to play Bitcoin. Old curmudgeons that secretly want the world to fall apart. They don't own Bitcoin, they own gold. So, but that's kind of cheating because that's kind of a reason I've made up for what I've observed, I think. If I was a tech investor, I would certainly be learning. We had the internet wave, we had the cloud wave. Cloud doesn't look like it's over yet, but I would certainly be looking into blockchain very deeply and to the possible disruption it might take. But I think fundamentals are fundamentals. Look, when companies are losing money, capacity is always going to shrink and their margins are going to look better in 3 years. When companies are over earning, their margins are going to come down in 3 years. I think all that stuff will be out there. I think the great thing about my original mentor, Spiros Drelis in Pittsburgh, was he made me focus on what moves the stock price. That would be my number one advice to the young people. Do not invest in the present. The present is not what moves stock prices. Change moves them. And I want you to try and envision a different world in a year and a half from now and where these security prices would trade versus now, given the world you envision. That would be my number one advice to a young person getting into business. I frankly made a fortune from 82 to 87. I was a Ronald Reagan nut, and I was wildly bullish. And frankly, from 95 to 99, I did really well. Look, there was an old timer. Most of your listeners won't know this guy, Robert Wilson, one of the greatest short sellers ever. It's really cool to make money in a short because it's different. But any great short seller will tell you they made 90% of their money on the long side. The math is with you.
You kind of talked about being low conviction now. You're not actually short equities, though maybe you'd like to be, or you think you might be in future. What do you think getting to higher conviction in the current environment might look like?
Oh, I think if the market were to rally 15 to 20% from here over the intermediate term, I'm going to take a shot because 6 month bear markets preceded by asset bubbles don't exist historically, and I think we still have a lot of wood to chop. If I
You're waiting for the dead cat pounds.
What's that?
You're waiting for the dead cat pounds. You're waiting for the
Well,
false.
it might not be so dead. That's why I'm not still like invested the way I was 2 or 3 weeks ago. I was quite short. Um, Interest rates. I want to hear where the Fed is. I want to follow the company data we're following to see how this thing is unfolding. And then, of course, there's this whole inflation debate. And I could see, like the Fed says, food and energy don't count because they're core. Well, tell that to a labor union who, what do you think? They're going to go in there and they're going to negotiate, say, okay, guys, don't worry, we only need 3% because the core PCE is only up 4%. We're not worried about the fact that our own cost of living is up 16%. So I want to see if that's embedded. I want to see all this. By the way, one of the reasons, in addition to low conviction, is back to what we we're talking about. I'm taking a mental break. I'm at work, but I want to be fresh. And this has been a lot of activity the last 4 or 5 months, and it may be in a week, it may be in 3 weeks, it may be 3 months. I'm in no hurry here. I'll need
So
to see
you're tapering before the marathon. You're giving yourself a break before you expect to get pretty busy.
or I'm in the marathon and I'm not running full out on mile 16.
Yes, yes. Um, if you were, what do you think 20-year-old Stan Druckenmiller today would be getting into or doing differently? As you just look at, or maybe, this comes up in, as you give advice to, I know you talk to kind of college students a bunch and things like that. But again, the investing game has changed a lot. And so, maybe it got made more sense to get into bonds back when you could do interesting things there, back when the markets weren't so wacky as they are today. You have a particular skill set, you're not going to learn, entirely new domains, maybe at kind of at this stage. And so if you have a very sharp, very hardworking investor who is looking at what should they become an expert in to be really successful, where would you be steering them that, is maybe different to where you play?
Well, the first thing I'd tell them is if you're not really passionate, if you don't love this stuff, go do something else. And I've hired guys with IQs 50 or 60 points higher than me who stink in my business because, and by the way, they could be off inventing or starting new companies that could do very well. But I actually think the next 4 to 5 years are going to be tailored to the skill set that worked for me in the 80s and 90s, which was all sorts of macro chaos. And I would encourage them to learn all the asset categories and how they integrate. Not easy. If I was a tech investor, I would certainly be learning, we had the internet wave, we had the cloud wave. Cloud doesn't look like it's over yet, but I would certainly be looking into blockchain very deeply and to the possible disruption it might take. But I think fundamentals are fundamentals. Look, when companies are losing money, capacity is always going to shrink and their margins are going to look better in 3 years. When companies are over earning, their margins are going to come down in 3 years. I think all that stuff will be out there. I think the great thing about my original mentor, Spiros Drelis in Pittsburgh, was he made me focus on what moves the stock price. Like, you can't just say, Stan, okay, this is a great company and the earnings are great. He said, tell me how people are going to think differently in 18 or 24 months about the situation than they're thinking now. That would be my number one advice to the young people. Do not invest in the present. The present is not what moves stock prices. Change moves them. And I want you to try and envision a different world in a year and a half from now and where these security prices would trade versus now, given the world you envision. That would be my number one advice to a young person getting in the business.
Didn't that happen to a surprising extent during COVID? That
Yeah.
people were always investing in the present, where airlines will never make money again. Oh, actually, airlines are fine. A bunch of internet beneficiaries are the greatest stocks in the world. Oh, actually, maybe they're just kind of normal companies. But why? It seems like the stock market was pretty inefficient over COVID. Why were people investing in the present rather than 2 years out?
I think it's what you said earlier. I think a lot of new investors, particularly retail, came in and they were rewarded immediately in the early parts of COVID. Supposedly there's like 400 billion in retail in the market now that wasn't there 2 years ago. So they were rewarded immediately by buying Amazon and buying the stuff, huge, obvious, immediate Peloton, COVID beneficiaries, but they'd never played the game. I don't have the nerves I used to have, but this was the best short selling period I've ever seen the last year or two, because never before were there such obvious over earners, like particularly brick and mortar retail. You see companies that don't grow for 15 years and all of a sudden, and I'm not talking about Amazon, I'm talking about old brick and mortar companies. All of a sudden the stocks have quadrupled. It didn't take a rocket scientist to figure out 2 or 3 years from now, people will start traveling again. Companies will overspend, all this stuff that typically happens. So I think COVID was a unique opportunity. I think the fact that all this new money came into the market made it even more unique and exaggerated in terms of opportunity.
Is that a common way you make money in equities? Is kind of spotting mean reversion, or noticing where people are maybe valuing a company based on last year's results as opposed to the steady state performance of the business?
I have a bias toward growth stocks. Luckily, not so big of a bias that I didn't ignore it the last year or two. But I think if you can envision a company that 3 to 5 years from now is going to be in a much, much better situation than it is today, long term, that's my bias where to go. But yes, on a cyclical basis, I've always done what you said, maybe because one of my first groups was chemicals, and they were really easy, John. When they were losing money, you were supposed to buy them because everybody shut capacity down the next 2 or 3 years, but people are still going to need chemicals. And when they made a bunch of money, this was when the markets weren't efficient. They used to announce all these capacity expansions so you knew what was going to happen. Well, I've taken those lessons, forward 30 or 40 years, and they still work. So, yeah, I do a lot of counter-cyclical stuff, but really I'd say the biggest money I've made in equities have been in growth stocks over time.
Um, when you talk about your bias for growth stocks, is big tech getting kind of too cheap for you to not be in it? As you look at a lot of the GAFAs, I mean they earn very large amounts of money, and so is that something that's starting to become attractive to you?
Not yet. I'm too bearish on the world um, to go there yet. Although I will say that they've gotten too cheap for them to be my shorts anymore. They were widely regarded as over-earners in COVID, and maybe they were early on, but it was so widely broadcast. The true over-earners were things to me like retail, trucking stocks, or today ocean shipping companies just have these massive margins. I can envision a world where world trade is not booming in 2 years, by the way. Um, so I think it wasn't obvious. It was obvious who the over earners were the first 6 months. All you had to do was go down the chain and pick them off the last year and a half. It's gotten much harder because 80% of that set is already down to a place where I'd rather not play. And I don't have my sandwich. I don't have bonds to go to and just ignore that world.
Yeah. And how about energy? You mentioned the world being short energy. How do you actually put that into, how do you actually trade that?
We're there. I mean, it's been widely publicized, people looking at 13Fs, by the way, which I would caution against because that's old data. And in this case with us, it's true. Very nervous because it's not the unique thesis it was 6 months ago in terms of looking out 18 months where these companies might be. But I think the reasons we're still there is we just see this thing as being more sustainable because of ESG and all the reasons we all know about, that it can last a while, and that doesn't seem to have been priced in the stocks.